Hello, this video will review the topic of financial management and securities markets based on the material covered in the textbook Introduction to Business published by OpenStax in 2018. We will review the following topics in this order. First, we will go over the role of finance managers. Then we will discuss how organizations use funds. After that, we will cover how to obtain short-term financing. And then we will discuss long-term financing and equity financing. We will then review the securities markets, buying and selling, security exchanges, and last, we will go over some of the trends in financial management and security markets. Let's get started. Every business needs money to run, whether it's buying supplies, paying employees, or growing the company. Finance helps businesses manage their money wisely to meet their goals. Financial managers work with all departments to plan how money is spent, track daily cash flow, and decide how to raise or invest money. They help make sure that the company always has enough cash and makes smart financial decisions. The goal of a financial manager is to increase the company's value, not just make quick profits. This means thinking long term, even if that involves some risks. For example, Corning, the company behind Gorilla Glass, invested in new technologies and research for years before seeing big returns. Financial managers use tools like financial planning, investment decisions, and choosing the right mix of debt and equity, which is ownership money versus borrowed money. And they work closely with accountants and other managers to make smart choices about the future. A key idea in finance is the risk-return trade-off. Bigger rewards usually come with bigger risks. Managing money well is essential to a company's success. To succeed, a company must keep spending money wisely on both short-term needs and long-term investments. Financial managers handle this responsibility. Short-term expenses like salaries, supplies, and raw material help keep daily operations running. Managing cash is key. Companies must have enough money to pay bills, but not hold too much idle cash. To manage excess cash, financial managers invest it in short-term, low-risk options like treasury bills or CDs. Accounts receivable, which is money owed by customers, must be collected quickly. Financial managers set credit policies that balance boosting sales and avoiding unpaid bills. Many businesses use software or even outsource collections to stay efficient, though this can carry security risks. Inventory is another big cost. Financial managers work with other departments to avoid having too much or too little stock. Tools like just-in-time systems help inventory control levels and costs. Long-term expenses or capital expenditures include big purchases like buildings, machines, or new businesses. These decisions are made through capital budgeting, which compares project costs with expected future returns. In short, financial managers keep the company running smoothly today while also planning for growth tomorrow, making smart choices that balance costs, risk, and future reward. To raise money, firms use three main sources: borrowing, which is debt, selling ownership shares to gain equity, and using profits or retained earnings. Financial managers choose the best mix to maximize the firm's value. Short-term financing is used for daily operations and can be repaid within a year. It can be secured or unsecured. Unsecured options include trade credit, where suppliers let buyers delay payment, creating accounts payable; bank loans, which includes lines of credit and revolving credit, helpful for seasonal needs; commercial paper, which is large companies issue short-term IOUs at lower rates than bank loans. Secured loans require collateral like inventory or accounts receivable. If the loan isn't repaid, the lender can take the collateral. These are often used by firms with weaker credit. Factoring is another option where a company sells its accounts receivable to a financial firm at a discount for immediate cash. It's commonly used in industries like trucking, clothing, or furniture and is more expensive than traditional loans, but provides fast funds when needed. Each financing method has its trade offs in costs, risks, and flexibility, and financial managers must choose based on the firm's need and creditworthiness. A key finance principle is to match funding length with how long a company will benefit from the expense. Short term needs should use short term funds. Long term investments should use long term financing, which includes debt or loans and equity or ownership of retained earnings. Debt financing is cheaper due to tax deductible interest and doesn't dilute ownership. It adds financial risk because of missed payments can lead to bankruptcy. Equity financing is safer since it doesn't require repayment or fixed payments, but it is more expensive and gives investors voting rights. Common forms of long term debt include term loans, loans lasting 5 to 12 years with regular payments, bonds, which are company IOUs, typically for 10 to 30 years, with interest paid semi annually and full repayment at maturity. Mortgage loans, which are loans secured by real estate lenders, can be repossessing property if payments aren't missed. Equity financing is the process of raising money by selling ownership in the company. This can be done by selling common or preferred stock, reinvesting profits or retained earnings, or securing venture capital. An IPO or initial public offering is when a company sells shares to the public for the first time. While it can raise lots of capital and make early investors wealthy, IPOs are expensive, risky, and increase public scrutiny and regulatory demands. Common stockholders have voting rights and may receive dividends through companies, though companies aren't required to pay them. Retain earnings, reinvested profits, avoid external costs, and are often used by high growth companies. More stable firms usually pay regular dividends, which can help attract and keep investors. Preferred stock pays set dividends and has priority over common stock in bankruptcy. But it lacks voting rights and is more expensive than debt since dividends aren't tax deductible. Venture capital is the source of funding for small, high growth firms. Venture capitalists invest in exchange for ownership and a say in management, aiming for high returns when the company goes public. This funding is hard to secure, so some startups turn to angel investors or wealthy individuals or foundations seeking big future returns. Securities markets allow investors to buy and sell financial assets like stocks and bonds quickly and fairly. Stocks represent ownership or equity, and bonds represent loans or debt. These markets include the primary market, where new securities are sold by companies, governments, and the secondary market, where investors trade existing securities. Key players include investment bankers who help organizations raise funds by underwriting new securities, and stockbrokers who buy and sell securities for clients. Many investors now use online platforms like Schwab, Fidelity, or Robinhood for low fee trading. Bonds are loans made to companies or governments and change value with interest rates. Types include corporate, municipal, and U.S. Treasury bonds. Riskier bonds like junk bonds offer higher returns. Bond rating by agencies like Moody and S&P help assess the risk. Other investment options include mutual funds, which are professionally managed diversified portfolios. ITFs, like mutual funds but traded like stocks. Futures and options are contracts for buying and selling assets in the future. These are risky and used by experienced investors. Online investing and competition have driven trading fees down, increasing accessibility and pushing firms to offer more services to attract and retain customers. The stock market is mainly made up of secondary markets where most trading happens. These are divided into broker markets and dealer markets. In broker markets like the New York Stock Exchange and American Stock Exchange, trades happen on a central floor where brokers match buyers with sellers. The New York Stock Exchange is the largest and most prestigious listing, over 2,400 companies. Regional exchanges like Boston or Chicago handle smaller trades. Dealer markets, such as NASDAQ, don't use trading floors. Instead, trades are made through networks of dealers called market makers who buy and sell securities. NASDAQ is the biggest dealer market and is fully electronic, using major companies like Apple and Amazon. Outside these, over-the-counter markets and electronic communication networks allow trading of smaller or less regulated companies and large institutional trades, respectively. Stock markets have gone global with major exchanges in London, Tokyo, and emerging markets like India. US and global investors benefit from international opportunities. The SEC regulates U.S. markets through laws like the Security Act of 1933 and Sarbanes-Oxley Act of 2002. Self-regulation is also key, with groups like FINRA in ensuring ethical practices. Whistleblower programs now reward those who report financial fraud. Key trends in financial management reflect broader industry shifts, such as technology improvements, operational efficiency, stricter regulations after corporate scandals, and increasing mergers in global markets. The SEC has taken a stronger role to protect investors. Online brokerages are competing with expanded services and competitive fees. The role of CFOs has evolved with a focus on corporate compliance with laws like Sarbanes-Oxley, while balancing strategic business input. CFOs are now seen as key partners in business decisions, responsible for accurate financial reporting and clear communication with stockholders. They must also navigate regulatory changes such as Dodd-Frank. Meanwhile, competition between the New York Stock Exchange and NASDAQ has intensified, with both exchanges expanding internationally through mergers and acquisitions. The New York Stock Exchange merged with Euronext, while NASDAQ increased its stake in the London Stock Exchange. These actions reduce market fragmentation and strengthen the exchanges through the competition, though the competition continues. In summary, financial management now emphasizes technology, regulation, strategic partnerships, and global market consolidation. Thank you so much for watching this video. Please subscribe and be sure to check out my TPT store for resources to match.